But let's first talk about the Fed. All eyes on the central bank beginning their two-day meeting. And Brian, I'm thinking back to just a week ago. The expectation has shifted dramatically. It was going into this meeting a 50 basis point hike. Now it's 75 on the table.
Yeah, so it's been a whirlwind for me personally. But if we just kind of rewind to the market action that we've been seeing, I mean, you're looking at Fed funds futures markets this morning. This is essentially the betting markets for where Fed policy could be going. And you see right now it's about a 93% chance of the Fed going by 75 basis points at the conclusion of tomorrow's meeting at 2 p.m. For reference, yesterday, that same figure was about 30%. And then prior to the inflation report, that consumer price index read that we got on Friday morning, it was about 3%. Now, keep in mind, this is during a Fed blackout period. We don't usually hear from the Fed officials. We got that Wall Street Journal report yesterday that had the word likely in the headline. There was no attribution in that particular story. But Nick Timrose, who's the reporter with the Wall Street Journal, someone who's very close with those inside the Fed. So you wonder, maybe this was information that was put out there to try to get markets ready for that surprise announcement, if that is indeed the case tomorrow. But my understanding of it is that it is going to happen, probably, that 75 basis point move, and they essentially want the optionality as they start that meeting today.
Yeah, and we've heard from a number of economists as well, JP Morgan, Goldman coming out with this expectation of a 75 basis point hike. My question to you is, why float that out there now? I mean, some would argue that the shock factor is gone. The shock factor is gone, right?
Yeah, certainly. And I think that what we need to understand here is that this is such a precarious time for markets broadly. The volatility, as we saw, not even just yesterday, but over the course of 2022, has been remarkable. And when we talk about the Fed, we need to understand that what they've messaged, right, prior to essentially yesterday was 50 basis points in June, 50 basis points in July. But we have to remember that that agreement, which was codified in the May minutes, was actually conditioned by the fact that if conditions were different, if inflation came in more than they were comfortable with, then they could change that strategy. And essentially, that seems to be what's playing out. Again, we'll get the confirmation of that tomorrow. But again, to your point about why leak that 2 days before the meeting? I mean, I can't get into the head of Fed Chairman Jay Powell, but if it is indeed the case that he was kind of behind some of this strategy here, it's probably to get markets ready. Because if you kind of give the optionality of, the Fed officials coming into town, which, by the way, the meeting only started 3 minutes ago. Okay, so this Wall Street Journal report preceded the members of the FOMC, the Fed presidents, coming to the table to even begin this discussion. Well, now at least they have an extra bit of information, which is looking at how markets have reacted so far to what is essentially a full-blown conclusion that they're going to raise by 75 basis points. Maybe that gives them a little bit more comfort if they did want to go with that more aggressive.
Well, and then the next question, naturally, is if they do go for 75 basis points, based off of what we heard or what we saw in the data on Friday, out of concern about inflation running out ahead, well, then what's the next lever, right? I mean, that's a pretty aggressive move.
At some point, I mean, if 75 is the move tomorrow, you think that might be the new floor as inflation remains at paces we haven't seen since the early 1980s. If the Fed at some point wants to lower that to 50 basis points again, which would still be increasing interest rates, does that send a whole new message to markets, right? That's something the Fed is going to have to grapple with. That's why Evercore ISI is warning this morning, maybe this is going to be a mistake. We'll have to see how history bears that out. But let's get a little bit more commentary on this with Payne Capital Management President and Payne Points of Wealth podcast host Ryan Payne. You've been hanging out in the wings, just I feel like waiting just to jump in.
Chopping the bit over here.
Yeah. Well,
yes.
Hey, you're in with us in studio. Give us your thoughts about what's been going on. I mean, this is pretty substantial. The Fed making this very quick pivot 2 days before the meeting begins.
It is, and I think what you said is optionality. And the Fed's been good at signaling ahead of time so the markets don't get spooked. And look, we've already seen a huge move in the Treasury market the last couple days. So I think the market's already ahead of this, and that's what you want, right? You don't want the Fed to come out with a surprise decision about interest rates and all of a sudden the markets go the wrong way. So I think a lot of that damage is already done. Hence Monday we saw, a cruel sell-off, and I estimated it. The Dow's at like 30,000. You only take about 32 days for it to go zero at the pace of yesterday. And then we can own all the assets.
Don't do this to us, Ryan.
And then you own all the physical assets for nothing, right? You could own the planes for Apple, Microsoft. We can just divide it all up. But I don't think the market's going to zero, but I do think that a lot of this repricing is happening very dramatically in real time.
So what's likely to happen then? If we do, in fact, hear from the Fed tomorrow coming back and saying they are going for that 75 basis point hike, what's the reaction? I mean, we've seen the sell-off over the last 2 days. S&P 500 now in bear market territory. Do we see a rally on the back of a little more clarity and some relief that the Fed's going to move more aggressively?
Yeah, I think that's possible here, right? Because I think the dire situation is already being priced in, right? We've seen equities this year go down dramatically, especially anything that's tech-related. Bitcoin right now,
yes.
which I did call a bubble on your show many months ago, but I do digress. And on my podcast, I talk about that as well. But bottom line is, you're getting a lot of deleveraging right now in the system. The markets are doing all the heavy lifting for the Fed. And in my mind is, look, you've got this economy that's red hot, right? I mean, look, you have unemployment's come down to a 50-year low. GDP growth over the last 5 quarters has been over 4%. It's like a runaway train. And what's the Fed trying to do? They're trying to put the brakes on, and they're doing that, right? You're starting to see it. Lumber prices have come down. Copper prices have come down. So my thoughts are, and going back to optionality, is maybe later this year, if things do slow down, maybe the Fed can be less hawkish. And in my mind, that's pretty bullish, right? Because at some point, they surprise and they don't hike as much as they're hiking right now. That could be very, very good for them.
Well, I guess, though, the question is, how does the train stop, though? Does it hit a wall, or can it slow down and get that soft landing? What do you think is the outcome here?
I actually think the Fed's doing a great job. I'm probably not in the majority on that opinion, but I think they are slowing things down. It's not coming to a halt, right? But we're already seeing that again in some of the commodity prices. And I do think that they may get that soft landing where things slow enough that they have the optionality later where they don't have to tighten too much and take the economy off its rails. And probably good chance we'll avoid a recession here, no matter what they tell you. I mean, I don't think a recession is a foregone conclusion like a lot of the headlines are telling you.
Let's talk about strategy. You're a big value guy. We were talking yesterday about really the broad-based sell-off that we saw. Even the energy names were down. What do you do right now? Do you add to your portfolio? Are you finding good buys out there? I mean, what's the thing?
He's not going into crypto, it sounds like.
You're
not going into crypto. You're not going into growth. You're not doing Tesla.
Yeah.
But what's the thinking right now?
I think you buy with impunity here. Look, I mean, as a long-term investor, you buy when there's blood in the streets. There's blood in the streets right now, and it's kind of like Revenge of the Nerds. Now, how horrible it was to go to a party in the last year and be like, I don't own crypto. Everyone's making all this money in crypto. I feel left out. Well, all the crypto bros are losing their shirt. You're getting margin calls, and that's selling off all those names that your grandfather loves or your grandmother loves, right? I mean, all those old school value stocks, which have held up way better here. If you look at a portfolio of value stocks, it's down less than 10% this year. The only bear market you're seeing right now is in growth, disruptive technology, and Bitcoin. But the reality of it is now you're getting on. If you take tech out of the S&P 500, you're trading at 14 times forward earnings. That's so cheap. That's been as cheap as it's been in years. So I think you have a gift from the gods here as a long-term investor to buy.
Well, but at the same time, though, if you're getting into value, I mean, it's not necessarily good for your portfolio because, as you mentioned, you're just down single digits instead of maybe down deep double digits. I mean, you look at, for example, the banks. I mean, I saw a note from Wells Fargo. Mortgage banking income could be down 50% from the first quarter. That's one of those value stocks, right? So, I mean, how thick of a skin do you have to get into that right now?
I don't think you have that much. I think we've already priced in some sort of recession if we have one or don't have one. I think most of the damage is done here. You may get some more selling on the downside, but at this point, how much you're going to get, I think you've probably seen the magnitude's already been done. The damage has been done at this point. You can buy anywhere in here as a long-term investor, unless you need a yield to lunch today. If you're not a trader and you're an investor, this is a gift from the gods. You got to take advantage of it to create long-term wealth. And for our clients, this is when you buy. You need an inflation hedge. Stocks historically are one of the best inflation hedge you can possibly have. Dividend yields are going up this year. Earnings are going up this year. And we may still have positive GDP growth. I'm still in that camp. And these are all good things.
So let's end with 3 names. 3 names that you think investors should be looking at right now.
We just talked about the banks. I think the banks probably have been, aggressively sold here. So like JP Morgan's a great place to buy right now. Loan activity should go up this year. You should get a steeper yield curve at some point. I still like energy. I think energy is a longer-term play. Valuations are still very attractive there. And in addition to that, since we're on Yahoo today, I even like Verizon right now. I think in old school.
No longer the parent.
Yeah, we're not.
I take that back. Formerly. But they were great when they owned you. So, yeah, I think any of those old school value names right now are great to have in your portfolio. And again, don't think twice here if you're a long-term investor.
Ryan Payne, good to have you in studio.
My pleasure.
Payne Capital Management President. Payne Points of Wealth podcast.